What's up everyone, welcome back to another video with the Millennial Finance. Over the last year, many millennials have just started their investing journey. While we've had a pretty good stock market so far, things could get a bit more turbulent moving forward. So today, I'll be talking about what we should do if our investments are in the red. Cha-ching! We've gotten lots of comments, lots of DMs, people who buy stocks and their stocks are down, or they put it into Stashaway or Wahid, 1 week later they check in and it's negative. Well, yes, your stock market returns can be negative. But let's get straight to it on the first thing that we shouldn't do actually, which is don't panic. We're all long-term investors here. Especially if you're putting it into ETFs or a robo-advisor, what we're doing is we're putting in our money and hope for it to compound over tens of years. The first thing that we want to do when these things happen is that we should calm down and not panic sell. I know that it's easier said than done, and it'll definitely take some time getting used to it, especially if your portfolio is larger. I've done it many times before, when the stock market drops, I sell my positions only to see the stock fly right after that. I guess it's a curse. Every time I sell, the stock will 100% go up. I noticed that for me personally, this is one of the most difficult things for me to overcome, and if I constantly buy high and sell low, it can be detrimental to our long-term profits. After all, dips, corrections, and bear markets happen all the time. It's normal, and we shouldn't be so surprised when the time comes. On average, we should expect a broad stock market decline of at least 10% every 2 years and 20% every 4 years. Let's look at a chart from March of last year of the S&P 500 when things really hit the fan. When we look at the short-term daily chart, things look pretty bad. It was going up very slowly. It was going up taking the stairs, but when it declined, it took the elevator down. At the peak of it, in just 1 month, stocks declined by 33%, and it seemed like the end of the world when everything was dropping more than 10% in a single day. When we zoom out a bit and take a look at what happened after that, then it doesn't really look too bad at all, right? Zooming out even further and looking at the monthly chart, the March 2020 drop only looks like a minor blip in the ongoing journey of stocks going up. Of course, a big part of this entire thing is that the entire US market has been doing very strongly ever since 2008. It's been in a huge bull market, and even though we can't guarantee that this will continue, it at least gives us a bit of perspective. So when these events happen in the future, it's important not to panic sell our investments just because the stock market is going down. So now that we've chilled out about things, we're not panicked, we haven't hit the sell button 5 hours after the market drops, we have to decide on our next course of action, and we have 3 things generally, which is buy more, hold, or exit your positions. So I'll be talking about each situation and in what scenario we want to employ the different strategies, and I'll start by buying more or buying the dip. This is of course the usual course of action for most people, for most investments. Whenever stocks drop, we want to be buying the dip. It's something that has been working for a while now. Every time stocks drop like 2-3% or even Bitcoin, everybody on Twitter, everybody on Instagram is going to be shouting, diamond hands, buy the dip, the stock market will go straight back up. I mean, in a way, it kind of makes sense, right? If you liked Apple stock at $150 per share, then if it dropped to $120 per share, you should like it even more. It's kind of like 11/11 Shopee sales, except instead of items, it's stocks. If you bought major market dips in 2008, 2018, and 2020, then you'd be doing pretty well for yourself, and you'd definitely outperform those who just held or sold their positions. In fact, broad market corrections are one of the best times to buy, whether you're just buying an ETF or an individual stock. For this, one piece of advice I have is that we shouldn't try to time the bottom because it's impossible to tell, and this is something that I learned from personal experience from March of last year. Being a relatively new investor myself, going through that correction or that bear market for the first time in my life, I thought that I was smart. Surely the stock market will go down more, I'm just gonna wait. But in the end, it just shot up without me, and I had to buy at higher prices than what I would have liked. Instead, we can spread our buys across multiple checkpoints. So let's say you decide to yourself that every 3% or 5% dip you're going to be entering, and eventually you should be getting a pretty good average price. Now I'm going to talk about individual stocks specifically. This method is especially true if the stock that you own is dropping for no particular reason or for a reason that you think it's unjustified. For example, Amazon's last quarterly report in Q2 of 2021, the stock fell by I think more than 5%, and it was because they guided to lower revenues moving forward. On a high level basis, we might think that's bad. Why is Amazon's revenue slowing down? However, if you dive a bit deeper into why they think their revenue will be lower, they do mention that they think that the e-commerce section is the one that will see a decline in revenue, but their Amazon Web Services or AWS will still show strong growth. Technically, as an investor in Amazon, this is good news for us because the e-commerce segment has very low margins versus AWS, which has very high margins. Reading between the lines, I bought the dip. I don't think that it justified that massive drop, but we'll have to see in the next quarterly report and see what they show. This, however, only works for companies who have very strong fundamentals, and you think that investors just have misunderstood what happened in the short to medium term. There are scenarios that we shouldn't be buying the dip, and I'll be going into the next option, which is selling your position. Sometimes stocks drop for a reason, and not every time it will go back up to the level that it once was. A very common mistake that many new investors make is that, this stock price dropped by 50%, surely it will go back to where it once was before. Well, I got news for you. Some stocks just keep going down and never see their all-time highs ever again. One of the most dangerous things for new investors is thinking that we can just always buy the dip because stock market will always go back up, but that is not the case. Sometimes cheap stocks are cheap for a reason. This doesn't really apply to ETFs though. So for example, on the S&P 500, unless there is some extreme or drastic change about the US economy, it's very unlikely that we will sell something like the S&P 500 during a market sell-off. This is more for stocks, so in this case, sometimes they do fall because of news that fundamentally changes your bull thesis. I'll give you another example here. Last year, myself and a lot of other investors were very excited about this young growing company called Fastly. Growth was great. They were taking away customers from legacy providers, and their two largest customers, or maybe two of the largest customers, were TikTok and Amazon. However, quarterly reports started to get worse and worse, and they lost both TikTok and Amazon as customers in a very short amount of time. Investors could also see that they were executing very poorly, management wasn't good, revenue growth was slowing down, and they were also lagging behind their competitor, which was Cloudflare. There were huge dips multiple times on this stock, but this is an example of a scenario that we don't want to just be buying the dip and hoping that it goes back up. Because their results changed my conviction in the company, so I bought this company just because I thought that they can grow revenues very fast. When they released quarterly reports showing me that they can't, I sold off my position. A very wise quote that I always see on Twitter is that I don't mind being wrong, I'm just not going to stay wrong. And if I didn't sell my position earlier, I would be at an even bigger loss now compared to when I exited the position with just a small profit. Now, I'm not saying that Fastly is going to be dead forever, it will never go back to all-time highs. I don't know if it will, but at this point, it's better for me to just sell off this investment, and if they show in future earnings reports that they can get the revenue growth again, then I can always reinvest. Yes, maybe I'll be buying the stock at a higher price than what I can buy it at today, but sometimes selling your stock is an option. There's this dangerous mentality I think that's going on a lot now, where people say that you should never sell your stocks, invest for 20-30 years. In some cases, yes, but especially with individual stocks, we need to know when to hit for the doors. So yeah, buy the dip only if it makes sense. The third and final option we have is the most simple one. We don't even have to lift a finger or do anything, and it's just to continue holding your position. One of the reasons that this may happen is maybe you don't have enough money to put in more, or maybe you already have a very large position in this stock, and even though it dipped, you don't want such a large percentage of your portfolio in just this one company. For example, some investors have rules for their portfolios. They say I'll only put 5% in one particular stock. Even if it dips or goes back up, I will not add more. Another valid reason to do this is when a stock is dropping down in price because of short to medium term problems, but you think that they can turn it around over the longer term. However, you're not so confident they can do it. Maybe that's a 50-50 chance, so you don't want to be buying more. You just want to hold off and see how they perform. A good example of this for a stock that is in my portfolio right now is with a company called Teladoc. The stock price has dropped a lot recently because of very high costs associated with a recent merger that resulted in very large net losses every single quarter. I do think that the industry that they're in still has a lot of potential moving forward, but I don't want to be buying the dips right now because I don't know whether this company can execute it. I kind of have faith in their management, but I do want to see more quarters before I decide to add to my position. So because of this, I'm not selling the stock because I like the industry, I think they can do well, but I'm also not buying more because I still want to see more quarters of their execution. So that wraps up all the options that we have when we're losing money from our investment. If you only got one thing from this entire video, I hope that you remember when stock prices drop, do not panic. Take your time, zoom out, and then decide what you're gonna do next. All of this depends on the situation that we're in and the stocks or ETFs that we're invested in. Let us know down in the comments below, what would you do if the stock market dropped 20% in the next 3 months? Thanks for watching this video to the end, guys. We really appreciate it. Give us a big thumbs up if you enjoyed this video and subscribe to our channel if you haven't already. See you guys in the next one. Peace out.